Welcome back to another Econ podcast with Mr. Hagan. On this podcast, we're going to continue to talk about investing. And I just want to remind all viewers this video is not designed to give investment advice. Its purpose is educational only. This video and other videos in this playlist are designed to teach about the different theories of investing. If you want investment advice, please see a professional. Okay, so let's go back to thinking about the different theories of the stock market that I've been talking about on a lot of these videos. And there are four theories that I am paying attention to. There's many other theories, of course, but these are the four that I'm paying attention to. And I've talked about three of them so far on this playlist with previous videos. And I'm going to add a fourth theory in this video, but let's start by kind of reviewing where we are. So first of all, the first two theories I talked about were over here. They were firm foundation and Castle in the air. Now, for you guys who have watched all these videos, the firm foundation, these guys are worried about intrinsic value. They're trying to figure out what the actual value of a company is, and they do this by looking at things like the PE ratio. They look at the PD multiple. They look at things like the yield, and they try to figure out which companies, based on PE ratios, PD multiples, yields, and other things, they try to figure out which companies are the ones that are going to do the best in the future, and then they buy those companies. That's what a firm foundationalist does. And we said that the firm foundationalists make up the vast majority of the traders on Wall Street. And then we looked at the castle in the air. Now the castle in the air guys, they don't look at all this P ratio, PD multiple yield stuff. These guys look at graphs. These guys are looking at price charts over time. They are looking at prices and what they do over time, and they look for patterns. They look for price patterns over time, and they try to exploit those patterns to tell them when to buy and when to sell different companies. Okay, so they're going to use graphs and price patterns. That's called castle in the air. Now, the key to both of these is they are both concerned with buying individual stocks or companies. Okay, firm foundation is trying to find which companies are going to do the best in the future based on these metrics. Castle in the air is trying to pick individual companies that they think will do the best based on price patterns. They are both focused on individual stocks, individual companies. Okay. Now, we then shifted and looked at the random walk. The random walk, these guys are mostly in academics. These are academic economists who are doing research on the stock market. And they say that you can't predict the future. So P ratios, PD multiples, yields, price patterns, they don't work. There's no way to know which company is going to do the best in the future. You can't know that for sure. And so these guys really recommend three things. They just recommend that you buy all companies. They said you diversify. Diversify. They recommend you just buy all companies and diversify. Number two, they recommend that you hold for the long run. They say that you should hold for the long run. And number two, you should keep down your costs. Okay, so that would be your investment costs, your taxes, all that kind of stuff. So these guys generally going to say, buy an index fund, buy the total stock market index, and hold it for a really long time, 20, 30 years. Now, the key to that is they are concerned with buying the entire market. Okay, they are not concerned with individual companies. They don't pay attention to them. They don't care. Okay, they just want to buy all of them. All right, and then you just hold them forever. Sometimes this is just called buy and hold. Okay, buy and hold. Buy everything, hold it for the long run. You'll probably be happy at the end. That's a random walk philosophy. The last one that we're going to start to take a look at in this video is what is called long-term timing. Now, the long-term timers, these guys are also worried about buying the entire market. They don't worry about buying individual companies. Okay, they're worried about buying the entire market. However, as their name implies, they are going to attempt to be in the market during bull markets. So they're going to want to be in the market during bull markets, during major bull markets, and they're going to want to be out of the market during major bear markets. Okay? So let's talk a little bit about how these guys define this stuff. So let me just cover that up for a second. And so here's what these long-term timers might look like. First of all, they're going to define some basic terminology. So the first thing is they'll define what is called a secular bull. Now the word secular, that just means long-term, and the word bull means that the market's going up. Okay, so a secular bull market is a long-term uptrend for the entire market. Okay, again, entire market, that's important. They're not focusing on individual companies. And this might be 9 to 20 years, 10 to 20 years, could be a little shorter, could be a little longer, maybe 6 years sometimes, maybe 20, 22 years sometimes. But the point is just saying these are long trends, a long-run secular bull market. A long-run secular bear market, this is the same thing, only, okay, secular still means long-term. However, bear means down. So this is a long-term downtrend for the entire market. The entire market is in a long-run downward trend that could last, this very long period of time. That is called a secular bear market, a long-term downtrend. These are long-run secular trends. And then inside those secular trends, you have cyclical trends. Cyclical, the word cyclical here, and these words get confusing, secular and cyclical. Secular is long run. Cyclical means short run. And this is a bull market, so it's short run up. So these might be 3 to 5 years, could be 1 year, could be 2 years. Okay, so but a cyclical bull is a short-term upward trend for the entire market. Again, entire market, not individual companies. And sometimes you will get what we call counter-trend cyclical bull markets if it is inside of a secular bear market. I'll show you a graph on this on a future video. Okay, but if you're in an overall downward trend, but you get a rally in the market, that would be a counter trend. It's counter to the long run trend, a counter trend cyclical bull inside of a secular bear. Again, I'll show you a graph of that on a future video. And then you have cyclical bears. Again, cyclical means short run, bear means down. So this is a short term downtrend for the entire market. And then, of course, again, you could have a counter trend cyclical bear, which is a short run downward trend inside of a secular bull. Okay, so those are all just a lot of definitions, and it probably leaves you a little bit confused just hearing the definitions. On the future video, I will show you what this looks like on a graph, and then we'll be in a little bit better shape to understand what all this means. Okay, so this has been Mr. Hagan on another Econ podcast. Thanks for joining me, and we'll see you on the next Econ podcast.